Okay, so today's class is on futures hedge pressure and monthly hedge pressure, dynamic overnight hedge pressure. It's another calculation that currently, as of the date of this video in January of 2025, we don't have automated in the Rocket Scooter platform for the most part. You have to do it yourself manually, but we give you the numbers and it's as easy as just drawing them. Now, before we get started, we're going to do a nice little quickie trade plan review so I can go ahead and walk you guys through what happened today, right? The market we opened up as a BSD, and let's just kind of talk about where Nasdaq and S&P were. We kind of rallied up pretty heavily into the overnight, which one of the things I just kind of don't like is that when you gap up and walk up to the DD bands. As you guys remember from the class in DD bands, DD band is the perfect exit target, and the DD band also has high volume pivots. And outside of the band, there are some stipulations as to what we do and don't do, right? So I'm going to review it really quick just so we can cover it. Let's go right up and get this. We have a new cheat sheet that we've made, so you guys make sure you grab this from the Discord. So as you know, the DD ratio kind of tells me which way it's going to pivot from the bands. When the DD ratio is bullish and we break out of the upper band, what we don't do is short. We don't short the market, right? There's a rule of no shorting above here and no shorting down here. On the bottom side of the bands, if we break, I always long it back to the band and close out. Above the band, I always trade up. I either long on the band itself to the next strong pivot, which strong pivots are going to be, as you know, monthly hedge pressure, bears on top, bulls on bottom, the three strong pivots you do. And illiquidity pivots are useful outside the bands as well. So I will long from the band to some strong pivot, or I will long on a bounce on a strong pivot to the next pivot, like strong pivot to strong pivot, as you see, small trade longs only. So today we were trading outside of the band on NASDAQ, and I go, oh man, that sucks. I usually like to see a really big run here, but that's okay because it still doesn't have me come in here and try to short or get out of this, right? 9:30 happens, the market rallies, I just wait, comes right back down and tests, and then it goes here and it looks like it's starting to break out. So keep that in mind that the DD band is right there, and I would go straight to Qs at the start of the day. At the start of the day, we open below monthly hedge pressure, which we all know about 90% of days close on the same side it opened on, which today is one of those days. But I digress. Before we get to the end of the day, we saw that we broke through and broke right back down and then broke again and started to consolidate. I decided to take along there on that particular move. Now, just as a pop quiz, this is the letters that they are now. What is the liquidity map? If you know my colors here, what are the letters right here that the liquidity map will tell you, just so we can go look it up? I'm going to quiz you guys to see what you know. The three letters. If we remember the courses, each of these letters means something. I want everybody to type what you think it is as quick as possible. People are saying B for bull zone, L above hedge pressure, and U correct, BLU. U and D has to do with this, the blue above the orange or not. If the blue is equal to the orange, in this case they are, then this letter is decided by is price above or below both of them. If it's above both of them, it's BLU. I'm very impressed that you guys do remember that, which is great. So what I'm going to do now is open up the liquidity map itself, so we could talk about the trade plan that I do take when we spontaneously break up into BLU. And as you know, I find every excuse I can to be a bull, meaning that when you bounce on blue, there's a trade somewhere else. So above blue, there's a trade to somewhere else. Usually, if you open above blue, it goes back to open. But in this case, we opened below when it broke up. So by default, you trade up to the next resistance, which we have to figure out what that next resistance is. Now, QQQ is unbounded. We didn't have anything above really to go off of. So I went to go look at SPY and ES for my clues. Is there a resistance there? And it just so happened that the S&P had its DD band as a resistance nearby. So if you guys know, I longed on that NASDAQ breakout as it started to consolidate here. And then when all of them started to rally, I closed out of my trade at the DD band like I'm supposed to. Do we all understand this? I watched S&P and NASDAQ together. Whichever one hits a pivot, I know I got an exit target. So one of the cool tricks about what we do is NASDAQ is completely unbounded. You don't just long and hope for the moon. You need to look around. When you're trading NASDAQ, look at S&P. When you're trading S&P, look at NASDAQ. And both of them were unbounded on the liquidity map side. NASDAQ on the future side had a gap fill. This is the big gap fill from the big gap down that we had. So we filled that gap here. We'll talk about gaps in the gap fill class. But also S&P futures had their DD band, which we always talk about. The DD band is one of our favorite exit targets. You guys remember from that class? So right when it here, I closed out of everything and I did nothing else because the market tends to just kind of like not have much momentum from here. Now, I never short from outside the band, as we always talked about in the DD band class. Absolutely no shorting because you have no idea how far it's going to go before it even tucks back in, even if it wants to. As 88% of days fall inside of the band, you don't bet that it does because why? Why do we not short it back in to the band? Even though there's a high probability that the market closes inside of this band, why don't we short a bull market back in? You don't know how high it's going to go, and you don't short a bull market. Good job, you guys. Yeah. Don't short a bull market. The stocks themselves are bullish with that ratio. Now, while it did maintain this kind of bullishness all day long, it took Donald Trump tweeting about Mexican and Canadian tariffs to shift the market around. Now, this, as you know, is not a structure thing. This is a catalyst thing, which brings up one of the key points in trading in general. You want to be in and out as much as possible, especially when Trump is president, because he snaps his fingers and it does this. Why am I in and out as quick as I can and not holding on the trades for 1, 2, or 3 hours, trying to get my scalps to get out of the way because of the volatility of what Trump is bringing to the table? Lots of tariffs and stuff, right? Lots of executive orders. He just jumped in office. So this came down here, was a catalyst that brought us back in. So the 88% of days also includes bull markets that pull back in because of an event. But had the event not been here, this would have probably held the fort without actually selling off. Does this make sense, you guys? So we don't normally short back inside the bands. Ignore all of this like it didn't happen. It's a news event. Typically, that's what you used to see. You're used to seeing is that you kind of hold the fort, and trading off the bands is also a really good spot to take all small trades, right? Okay. So when I was eating lunch, I heard the financial juice was like, woo, and I looked at my news and I saw, oh, tariffs. Okay, market's probably selling off. I'm completely far away from my trade. I was doing fairly well already in the morning, and so nothing happened. What I did do was I came up here and I was looking at my liquidity map, and I saw that we fell and broke through hedge pressure. And so the first thing that I do when I break hedge pressure is I know that the market is irrational. The lights are going to turn red, and I've already lost some confluence in any trade setup I have. I don't like to let an event that comes spontaneously like that fall to here and me buy on these things because we're already outside of the DD band as it is. And I'm already kind of seeing a catalyst. So my small trade is a sit out. And when it hits here, I'm convincing myself to sit out. Let me see how bad that news can be. Now, when the market fell through here, when I jumped on my computer, I was looking, aha, okay. Will it bounce here? Because usually I'll buy that dip. But I convinced myself not to, even though I was outside the DD band and the news was like, okay, let me trade zero. Even if I wasn't trading zero, when you fall right here, are there any clues that you have to maybe avoid buying this dip here? Do we have any clues that kind of showed us hold on for a minute and see? If your eyeballs come down to here, resilience was collapsing at that moment in time. Okay. And it fell right here. And while res fell from like 80 to like 10, I'm going to hold off and give it a little bit of time to see what it does. And as soon as res went negative, as you see, the negative resilience, the desire to fill the gap, smashed through hedge pressure, which is what we talked about, right, in previous class. So while monthly hedge pressure usually fights off resilience, this time it just didn't. There's probabilities that it doesn't, but usually monthly will survive, but weekly usually will not. Resilience and the desire to fill the gap is very strong. And when it went negative, it's like this immediately you guys should get excited about the trade. When you see this right here and you're not in a trade and res is less than zero in both cases, your brain says we're filling the gap. Did y'all all do that today? When you saw it hit monthly, you probably were convinced, let me wait and see. Then it fell below, and then you knew we were filling the gap, right? So did I. And the market fell and filled the gap immediately. Now, it bumped up to half gap. Again, strong pivots only when you're outside of DD bands, and strong pivots only if you manage to want to even touch the market during an event. Small positions and strong pivots only. MHP, bear zone top, bull zone bottom, your strong pivots. So when it fell here and it rallied up a little bit, if you guys remember my post in Discord when I was posting today about what I was going to do, if you recall, I did post something along the lines of, I'm aiming for bear zone top and let it fall. I'm waiting, resilience less than zero, so more downward pressure to go in QQQ, which is at half gap now, right at about 157. Okay, so right about here, which is 157, I go, nope, I'm waiting because res is still less than zero. It's still going to fall. And then we fell to my strong pivot. And what I ended up doing was I have two options. Number one, I could set up all this. I kind of wanted to trade because I need to hit minimums on these accounts. So I decided to long right here with one of my accounts, and then I longed right here with the other four. Do you all understand that the whole reason I went through this whole spiel was to tell you that I split my risk four different ways? My final win was just like that. When you split your risk, it is one of the best things you can do when you have two really long, strong pivots that you can trade from and multiple accounts to trade on. I preach daily to people that you should never trade all of your accounts at one pivot at the same time. When you have two strong pivots next to each other, you can use your multiple accounts to split your trades up so that one of them takes the risk. So in case the market rallied, I made some money in one of them. But in case it fell to my next strong pivot, the strongest pivot we have, my every single time trade that I do, I hit it with all four here. And as soon as it bumped up, I closed out. Does everyone understand the idea of splitting your risk? It's the same mechanic as taking one account and trading one contract here and adding four more there. It's taking one trade in one and trading in four else there. So we all on the same page? It's when you trade with 20 prop accounts, don't listen to your favorite Furu guru that's trying to get paid in all 20x. You can quote me on this, but I'm also paraphrasing somebody else. I don't know who said this, but basically it said, prop trading is about getting funded in 20 and getting paid in 5. It's a very powerful statement, which basically means this. You're going to be very, 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 very lucky to get in 20 and get paid in 20. What he was saying, whoever said that, I don't remember who said that, but the idea was get funded in 5, get paid in 4. If you split your accounts out, one of them is going to be what we call the first penguin that jumps in the water. You ever watch a bunch of penguins in a nature show on an iceberg? The first one that jumps into the water always gets eaten by a whale, literally every time. Nobody wants to be the first penguin in the water. So don't have all your penguins jump in the water on the first pivot, especially when it's risky. In a normal day, when there's no event, sure, I might hit all or most of my accounts at the same spot, but I won't even hit them at the same intensity. This morning, as you saw, I accidentally traded micros and minis, but some of them I hit it with 2, some of them I hit it with 3, one of them I hit with micros. I thought I was hitting them all with micros, but the whole goal was I accidentally hit them with minis because I was in the middle of a podcast. But the idea was I even hit them with different amounts of risk so I can play with different cost bases. And I'm not ever doing the same thing in all the accounts. The goal is if I blow up one account, I've got 4 more to hit the next target. And so that's really the secret, splitting up your risk, okay? Whether it's in one account, trading bigger at different places, smaller than bigger, or one account, 3 accounts, 5 accounts, 10 accounts, 7 accounts, 13 accounts. Do we all understand? Use your accounts to do that, especially when they're dirt cheap and you get them for 90% off. Use your evals to play the game. Market falls to here, long in 5. Falls to there, long in 5. Falls to there, long in 5. Falls to there, long in 5. You blow up 10 of those accounts is $200 of loss. No big deal. 10 of those passed on the first day. When they're dirt cheap, you want to play it like that. When they're very expensive, you don't want to play it like that. Do y'all understand, everyone? We can move on. This is just an icebreaker. When your trader funding program accounts are dirt cheap, you're just flipping those evals. I usually try to pass them on a single day. And then when I get funded, I take them seriously. But the idea is that when you're 90% off and they're $15 an account, don't worry about it. You're racing the clock for the sale to be over. And somebody said it changed the game. Yeah. So the idea is I might spend $1,000 blowing them all up, but by the end of the day, I've got 20 passed for less than $1,000. That's super cheap, right? So the idea is that if you're waiting, you're just going to run out of the sale, then they're going to be full price again. And then you have to grind it out. And so you want to get them locked and loaded, ready to go. Okay. Just letting you guys know that my trades today were very small. It was this and it was this. And in case you added up the numbers on the screen, it was $9,800 in my Tradeify account. That's it. I'm in and out. I'm in and out. I'm not sitting here all day betting on the market because Trump comes through and just knocks it the other way. And this is kind of what newbie trading is, to sit there and bet on direction, right? Because the market's going to do stuff like this most of the time. And when you look back on a chart, you're not going to know why this fell. You're just going to see that it fell. And this is kind of a pretty drastic day. And I'm luckily on the sidelines. You're going to realize if you follow our rules, get in, get out, you're going to luckily be on the sidelines more often than not. Okay. So any questions today about today's setups? I'm going to move on. I'm going to talk about overnights. It's a very quick and easy way to go through this one. Okay. Overnight dynamic hedge pressure. Now, usually, when we talk about liquidity maps and hedge pressures, we only have them for for equities, because we grab the equities options and we do them. So we do a special calculation with the equities options. It's still based on equities options to create futures hedge pressures. They're converted to match futures hedge pressures. Now, what we did was for the following, and I'll tell you why I invented this. So at the end, let me just pull up, let me go historic data. At the end of the stock trading day, there was an idea that if I kind of had an idea where tomorrow's hedge pressure would be, if market's selling off today, what would tomorrow's hedge pressure maybe be? I mean, we can kind of estimate it, right? Because part of the hedge pressure calculation requires a couple of things. I'm going to draw a clock so you guys can understand it. I'm going to write 9:30 in the morning, which is when the equities market opens. I'm going to write 4:15 in the afternoon, which is when the options market closes. Keep in mind that's 15 minutes after the equities market closes. Options trade for 15 more. Now, at night, Opera gives us the one piece of data that we need, that we only get once a day, and everybody gets once a day because they only publish it once a day, which is the open interest, all options that are available, period. This is every option that exists right now on our exchanges, or on the stock exchanges that are being traded. So we learned that SPY 500 calls has this many options, this many puts, SPY 510s, 520s, we learn everything. Opera gives one data dump to Wall Street, and that's it. We get it in the middle of the night, and then we take that data at 9:30 and we use part of that as the hedge pressure and zones equation. Part of the hedge pressure and zones equation requires the open interest. How many options are there? Part of it requires the price of the options themselves. Very important. And part of it requires the opening price of the equities to go with it, right? We need to know BLU. Where's that opening price at? So we needed the open interest, the price of the options, and then the Greeks. Let's put gamma to represent all the Greeks, but the Greeks and some other proprietary data that we take that all comes out at 9:30. But in case you don't know, is that once options start trading, we are completely in the dark. We have no idea what the open interest is. We have no idea how many SPY 600 calls are there, because immediately when trading starts, people are creating them, destroying them, trading them, and Opera has no visibility. They require people at the end of the day to report their positions to them, but throughout the day, trading's taking place all over the place and over the counter, and we don't know. So all of Wall Street is in the dark the moment that market starts trading. So the best visibility we have of all the pieces to give us hedge pressure and walls is exactly the moment the market opens, slightly after. When the market opens, we get the opening price, the Greeks, the price of the options, and all the proprietary stuff. And the moment the market opens, we know 100% of the open interest, but it quickly deteriorates as the trading day progresses. So the overlap when everything is known, unfortunately, is one time per day, which is why you only get liquidity maps one time per day, and they don't update because the open interest is unknown. Do we all understand? Once it's unknown, we don't know. If we had real time open interest, oh my God, we wouldn't ever lose a trade, ever. Do you understand how powerful it would be to know the real time landscape of the market? Monthly maps that updated every second, hedge pressures that updated every second. Oh my God, right? So nobody has that information because if that information were available, it would be the cheat code to the market. So we were like, okay, it'd be kind of cool to create hedge pressures to know maybe at the start of the day, we can find out that the market's going to have a strong pivot, but towards the end of the day, maybe it's not as strong because the open interest goes away. But the thing that you note is that as we found out, the pivots that we calculate at the start of the day, as everyone on Wall Street's in the dark, everyone still acts on that same knowledge, despite the open interest drastically changing. The bull zone, bear zone, and hedge pressures are what they are all day long, even though, theoretically speaking, hedge pressure could have moved here, or moved there, or moved there, physically speaking, right? Because the options are changing in real time. But what so happens is what we calculate stays static and people act on it still, probably because they have the same limitations we do. This is the best piece of data you've got, and then you know nothing else throughout the rest of the day. So people still plan off of the opening data, which is totally cool. So what we found out was that at the end of the day, I kind of was like, can't I take the open interest that we have at the start of the day and make some guesses at the end of the day as to what the open interest could be? An example is if I have 500 or 5,000 SPY calls at 500 strike for SPY, and I also see that the volume, which is updated in real time, you just never know what the volume is creating, destroying, or trading. And I see that the volume is 1,000 shares traded total. I came up with the idea that, well, if the open interest, which is the part that we don't know throughout the day, back on that clock when the market closes at 4:15, we know everything. We know price of the options, price of the underlying. We know all the Greeks. We know all the secret data. We know everything is when the market's open. We just have zero clue what the OI is. It's the one missing component. So what Dynamic does is it tries to make an estimate of what the OI can be. The one thing we don't know. So we take the OI that we had from the previous day and we look at the volume that we have traded throughout the day. And we make two guesses. We say, well, 1,000 contracts were traded. Either somebody wrote 1,000 new ones, or 1,000 got exercised and destroyed, or 1,000 of them changed hands. If 1,000 of them changed hands, people just handed them back and forth, the 5,000 is 5,000. If 1,000 of them were exercised, then the 5,000 becomes 4,000. If 1,000 were created, as somebody created new ones, 5,000 becomes 6,000. Do we all understand quickly before I move forward? We take this 5,000 and say, well, the open interest for that particular option is going to have to be somewhere between 4,000 and 6,000, hard limit. It's nowhere but inside of that range. Tell me you understand this so far, because it's going to explain why there's two blue numbers. It's the best we can do. All right. So we know that you just have plus or minus that amount. So we do this for literally the bajillions of options that exist, and we do this calculation for all of them. And then we create hedge pressure max and min, because we know what the open interest possibly can be on both ends, and we know all the rest of the pieces that go into the calculation. Therefore, right at the end of the day, we can do a calculation to create possible hedge pressures. The calculation is balanced to aim for the time of 9:30 the next day. And we give you two blue numbers and a bot overnight. I do them manually. We're going to automate this pretty soon in the platform. But right now, we give you a low and high hedge pressure estimate. What it says is that if price were to go absolutely nowhere overnight and open exactly at the same place, meaning no delta changes, nothing, and all that happened was time changed, then hedge pressure will be somewhere inside of those two blue lines. But as we know, futures move all over the place, so hedge pressure ends up wherever it ends up. But we said that'd be like a cool idea of the best that you can do. As markets fell here, hedge pressure is likely somewhere in there. And so if I was long the market and it's falling and falling and falling at the last minute, I got to make a decision. Should I buy some puts on my portfolio? Well, let me buy puts below hedge pressure. So here's an estimated range. So let me just buy some puts right there below it. I created this for that particular estimate. It's a good estimate, right? I need to know because if you break hedge pressure, markets get pretty gross. So I'll just park my puts below the lowest of the two options. It doesn't make sense. So it came to find out that as time went by, this was a great estimate. But as we observed this, we found out that the two estimates somehow are magically high volume pivots as well by accident. It was created as an estimate to put options on a hedge at the end of the day with the best knowledge you can do. But what we found out is that we stumbled upon a new dynamic thing that's going on. And when it took some time to figure out what exactly it was that we had discovered, but let me go ahead and draw them right here on the chart. So here's the overnight, and I'm going to pull from the bot 6061 and 6066 were the two blue numbers that we had. I don't think we came anywhere close. Yeah, we didn't come anywhere close to them today. They were off the charts, but let me go ahead and put them here. 6061 and 6066. And then 6061 was also the orange. The orange is monthly hedge pressure. We do the same thing for monthly, but instead of giving a range, we decided to give just one. Now, let me tell you the full story about what we did create. Not just the range, but we tried to do a full estimate of the calculation itself. We thought it'd be neat to know what is the min hedge pressure can be, what's the max it can be, and then let's actually guess actual. Let's try to make an actual guess. I wrote a sophisticated real-time open interest model that in the case of there being like a 4,000 min and 6,000 max, I tried to estimate roughly what is it actually going to be by looking for other clues in the market. An example is if the bid is, 200 options to buy and we saw a sell for 1,000 and that 200 was fully like the tiers didn't change and we saw 1,000 options show up in the time and sales, what it means is somebody wrote 800 calls to fill that order because the price didn't move and the order was filled at the same price, the same bid. Aha, there's a clue. 800 were actually created, right? So I was like, okay, I can do cool stuff like this to try to come up with an actual, which was my real-time open interest model. Remember, he who has the real-time open interest has the cheat code to the market, right? So you'll never have it, but I kind of wrote an algorithm to get as close as I could to it. Enter the reason why there's a min, a max, and an actual estimate. So what we found out was that the actual estimate is a very dirty, like assumption-based machine, as good as it can be, but the min and max are the min and max. These are rigid, hard pivots. Hedge pressure cannot exist outside of those ranges. So we said, you know what? Let's just kind of use the min and max as the pivots for the day. And lo and behold, look, today we fell to those pivots, right? The min and max. Now, we can give you 3 hedge pressures and 3 monthly hedge pressures, but then you're balancing 6 pivots. It's really hard to can do that. So the idea that we came up with as the years went by was, whenever you're trying to fill the 3 letters, B, L, U, for example, this one has to do with are you above or below hedge pressure monthly? And this one has to do with hedge pressure and monthly hedge pressure. So the idea was at the end of the futures day, stock day, could we guess at least 2 of the letters for the next day? And that's what this is kind of doing to tell you in the overnight that are we an L or are we an S? Are we a U or are we a not? So, or a D. So today, when futures gapped up, hedge pressure, technically speaking, is likely to be somewhere in here if price goes nowhere. Clearly, it goes somewhere, but going off the estimates, if all hedge pressure options could be here, and you were to guess at that middle letter and price is up here, somebody guess at that middle letter for me really quick. Take a guess. What is it likely to be the next morning? If price is here above all possible options of hedge pressure, price is above hedge pressure no matter where it is. So what is the middle letter? Take a guess. It's an L. So right here in the quote unquote overnight, it's like having an L in a liquidity map. There's a long and there's a hedge pressure range right there. And you can see the whole range is hedge pressure. Somewhere in here, it's going to bounce and go just like a BLU. And then if the hedge pressure range is above the estimated actual monthly hedge pressure, we could come up with a scenario that the majority of hedge pressure, or almost all of it, is above. Well, the blue and the orange are in the same place. They're both 61. So all possible hedge pressures are above the orange. Therefore, it's a U. So at the close of the day, we're guessing that today opens up LU 16 hours ahead of time. And the goal was, could we guess tomorrow's hedge pressure and liquidity map? It's an LU. So today we opened up BLU, didn't we? So this was an attempt to try to use some clever math to get ahead of the day in the futures session the night before for overnight traders. Aha, I'm trading a long up. Okay, so if the market were to fall right to here, just like I would with any long up, and what about the first letter? Because we don't do dynamic walls. It'd be very complicated because it's all a range, right? Every zone would have a range. It would get kind of messy. So the idea was, let's just assume the zone is what it was the day before. It's nice and bullish with a really strong DD. Hell, let's just assume it's a B and then LU. It just so happens we opened up in a BLU, didn't we? So the idea is as futures are trading around, if it were to fall right here and your brain goes, it's probably a BLU, what would you do right here off of all that hedge pressure, monthly hedge pressure guess? Mind you, it's a guess. You probably would long there. And that's what this kind of whole class is about. These overnights are what we found were like, okay, it's kind of an estimate of the range. But what we found out is that the pivots are razor sharp. And even into the daytime session, there's something interesting about the max and min open interest that creates beautiful high volume pivots, even during an event, even during a catalyst, even during the day session. That 6061, sorry, it's right here. They're not, these are at the same place. So 6061 and 6066 is that bounce and that bounce and that bounce and those bounces. For whatever it's worth, using the ranges to create estimated risk ranges is the best you can do because no one knows the open interest. So we must have stumbled on to what a lot of hedge funds and quant firms also do to gauge their risk, because everybody's either acting here or acting here. Some people are acting at the min, some people are acting at the max, but we find both of them are acting, which means other people in the institutional world are doing what we're doing because they're also hedging and acting at these numbers that the bot gave you last night, 6061 and 6066. A whole day later. And it took us a while to understand not only are these pivots good estimates, they are exact pivots and high volume. And even in the day session, there's a lot that goes on there and they actually pivot to. It was a crazy, 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 crazy find. Now, dynamic hedge pressures are going to be on your summary listed close to the bottom, like every other hedge pressure. But MHP still ranks up here like your regular MHP as well. So this was finally decided upon us to use this in the overnight as overnight pivots to trade on. And it just so happens they are amazing. Now, let me go ahead and show you NASDAQs from the bot last night. So at 5:45 Eastern, 15 minutes from market opens, I run the bot. 21,532 NASDAQ. Okay. Look at where we fell to today. It's insane. You'll see that? You'll see that? This pivot was from last night. It's a high volume pivot, and it's my real-time open interest model that I thought wasn't that good, but it actually is as good as you can get because I'm just guessing at the order flow, but it finds out is that that's the best guess anybody can do. I found the best that anybody can do. As weak as it is, we've stumbled upon the best, and that's what it really tells you. So it makes me really proud to find out that, and let me draw the other ones, 635 and 532 were the other numbers. So 532 is that, 635 and 532 is the other one is here. So last night, futures gapped and went, and I know I've got a 532 pivot, which is about right here. I'm just going to extend this all the way over here. So the way that you're going to use this is if you're doing any trading overnight, I love to use MHP and these dynamic hedge pressures as pivots. Now, these are at the same spot. I'm just staggering them a little bit so you can see them. Aha. NASDAQ futures opens above both possible blues. So just to reiterate, we give you the high and low estimate, and we don't give you the actual on the blue because it's just too messy. But we give you the actual on the orange so that you can fill out that second letter. So let's fill out the letters right now. If futures open right here, what is that second letter? Everybody take a guess. Or what kind of potential quote unquote liquidity map do we have? Are we above the hedge pressures or below the hedge pressures? Go ahead and type it in chat really quick. Above L, right? So cool. We've got a long hedge pressure, just like in the other long liquidity maps. Is this letter a U or a D? Are the blues above the orange or below the orange? If the blue is somewhere inside of here, it's likely above the orange. It's a U. And then, of course, you go to your liquidity maps and you go, okay, so what do the LUs look like? Well, BLU is pressure off of hedge pressure, and bear long up is pressure off of hedge pressure, right? So pressure off of hedge pressure allows me to say, well, I'm going to long right there or long right here because I'm going to trade at both of these. So I might put one contract here. The distance here is 100 and 100 points. That's a little rich for my blood. So I'm going to do one, stop at 40, one again, and trade right there. So now I can use overnight pivots as a decent place to trade. Now, tonight wasn't a good example of us touching those pivots, but I promise every single night when you see them and you touch them, they will be high volume pivots. And we used them overnight, which was great. But what we found was such a crazy thing because for whatever it's worth, NASDAQ is no different than the S&P. These things are massively strong pivots in the intraday. Imagine stumbling upon this by accident. The intent was to create an estimate, but what people pointed out over the years was that these pivots give you extra clues throughout the day session with an estimated open interest model, which means we've cracked something that somebody does with Matt's estimated model. You're welcome. So when you have your liquidity map side by side now, let me go ahead and open my layout. You will now see on my charts that I get a couple extra clues in futures. As I always keep my futures chart open on the right, you will see that I keep my equities chart on the left. Now, while I'm looking for as many clues as I can, you can use both of them for pivoting information as they stack up. While we have talked about the DD bands being futures pivots, we now have these estimated hedge pressure and dynamic hedge pressure in futures, again, as pivots. Ignore these yellow lines, but this is here. So if S&P is collapsing on news and you've got a bull zone there in SPY and you happen to have monthly hedge pressure and hedge pressure dynamics also there, the confluence has now doubled for your long setup. Why did I still take a long today despite the market falling on an event and there's a catalyst? And we teach you don't trade when there's a catalyst because I fell on top of two very strong pivots that both lined up and my confidence was really good. Do we all see that? You're going to see that there's a weird symmetry in the market. And the more you stack SPY next to the futures or QQQ next to the futures, you will see that there just happens to be this interesting symmetry in the market. And why do you think that is? And again, these classes become more and more revealing and mind-blowing. Your every single time pivots happen to line up with some of these. The close price lines up with hedge pressure. Why is there some kind of interesting symmetry, do you think, between futures and equities? Do you happen to take a guess? If somebody guess what you think is going on. Why does it seem to be that there's strong pivots lining up in both worlds from two different things? Arbitrage, Ian said. See, QQQ and NASDAQ futures both track the index that tracks the stocks. There's, as we've spoken before, like a little bit of a spring or a rubber band that connects to the index, right? NQ connects as well by a little spring. The index equals the stocks. So as people, market makers are trading in one, they're hedging in another. They're going to hedge there or hedge there. They're going to hedge all over the place. Buy the Qs, hedge the stocks. Buy the futures, hedge the stocks. Buy the stocks, hedge the Qs. Whatever the case may be, you will start to see very often that pivots just magically seem to line up in both instances because of that arbitrage, because people are buying in one and balancing in the other, hedging in the other world, as Lucas said. So coincidentally, when you put them side by side, you get extra clues. Now, you're going to trade your dynamic pivots just like anything else. If you open above, you're going to long or be long-minded at both of them. You're not going to short. If you open below hedge pressure, you do exactly what it says. This is the blue hedge pressure, like in liquidity maps as well. If you take a look at the liquidity map summary, opening below blue is no short. We don't short off of blue, which is one of the key characteristics of this. We long off of it every time, and we chase the blue break every time, but we never short off of blue. So if you happen to be trading in the overnight, and the overnights, ignore the orange, opens below the blue, you're not shorting off of the blue. You want to see if the blue breaks, and then you long from blue to blue. So above the blues, you long off of there, or you long off of there. Below the blues, you bet that you break if it does, and then chase it from there to there and close. And orange is the same thing. Now, we're doing a study right now to count the probabilities of each of these, but it's assumed that as of this date is to treat them the same as you treat the probabilities of the liquidity map. These are roughly 80% same side close, and these are 90% same side close. We're doing a study right now to give you more of a piece of data. So at the date of this video, we don't have the study done, but assume that 80% closes above the lowest of the two when you open above. And when you open above the orange, you assume 90% of days close above the orange. And as you see today, even in the equity session, when the futures market closed at the end of the day, closed above the lower and closed above the orange. The 80 and 90% held up. So remember when I say that you guys are used to using technical analysis to try to check out what's going on in the market, but now as you've learned that futures and equities have distinct different pivots, isn't it interesting that the symmetries that you see, monthly hedge pressure and hedge pressure in DD band, are at the same spot for the most part? Do y'all see that? And that bull zone and bear zone lines up with these real-time open interest models. This is based on the risk interval. This is based on an estimated OI interest model, like real-time. This is based on the actual OI. This is based on my market maker gamma exposure model. Different calculations with different inputs land at the same range of pivots fairly often because of that cross-market hedging. So what you're basically going to do is you're going to look at both at the same time and say, oh crap, why today, when this fell through here and resilience was negative, and I said, aha, the market's going to fall. Why did I tell myself I'm going to wait all the way until there to do anything? Because in the futures world, I did a quick estimate to say, oh, that's roughly here. And so pretty much here and here is where price is going to line up with that lower MHP. So when I make my stronger trades, if everything lines up with the dynamics, it's even a stronger oomph to the market. It was strong enough for me to take a bet at that bull zone, bear zone top at 521 Qs or 532 NASDAQ and take the long there from here to there. I traded my every single time from bear zone to bull zone, and futures spanned the two hedge pressure ranges as it tends to do. Which one do you do? It's completely up to you. I still follow the liquidity map in all my trade plans, but it feels extra confident when futures gives me the extra oomph to go with it. So remember, if you are breaking through hedge pressure monthly here, or you break through the futures hedge pressure monthly, they one or the other can cause the market to fall apart. So knowing that you have an extra level of confluence here just gives you an extra place to make sure, my liquidity maps, it's going to be pretty strong because I got my futures dynamic is here. And as Matt told me, it just magically creates high volume pivots when you get there as well. It shouldn't behoove you that this was the pivoting low before the rally. It doesn't like to break it, just like it doesn't like to break the equities one. But as much as it's worth, this thing became more actionable than we thought it would be. Now let's do one more. Like let me go back and just to kind of give you an example, let's look at yesterday's. I'm going to pull the bot up. I post them every night manually in the chat. So this is what it is, just so you guys can see. I'm going to move it off the screen so I can draw it. I'm going to draw it here in Thinkorswim. ES last 2 days ago was 60.72. Okay. And we'll wrap up the class here. Oops. 60.72. 60.57. Make sure I'm on the right day here. Okay. And then the orange one was 60.47. All right. I want everybody to participate this time. Price opens right here. It's not necessarily above all of it. So it could be an L or an S. We got both options. Oh, that's kind of But both of these are above the orange. So what is the third letter, class, everybody? If you don't know, you need to go to liquidity maps class. It's okay if you don't know how to do the letters. It's a U. So we either have a possible LU or SU. And when I go to the liquidity map, I can say, okay, well, what does LU and SU look like? Well, the LUs, we know we long off of the bottom hedge pressure. We just covered that one. And then the SU, you long off of monthly. And the SU, you long off of monthly. And you take the hedge pressure break. And here you take the hedge pressure break because SU becomes an LU. So as you see, in all the cases of LU, SU, SU, LU, there's all green arrows as well from either monthly or blue. So you have like blue is a long trade to some level, well, blue to blue. Forget the yellow line for now. Orange is a long trade from here. When you open in the middle, you tell yourself it could span the middle. So I allow myself to let it fall to the lower one and trade it back to the upper one as a trade setup. It ran into the upper one. I don't chase the long until it breaks and supports there. From the low, I tend to want to buy there and buy there. So when we open up, I tell myself, okay, I've got a couple options. Either A, I can long from here to there. B, if it breaks, I can long from here back to there, or I can wait for the chase and long out. Each one of this, this, and this will be high volume when you get there. So let me go to a 1 minute chart so we can kind of look into that volume there. As you see, just touching that level. Let's go here really quick. Get off of the open. So just playing with that level, slightly high volume relative to what's around it. But as you see, the set what actually broke and kept going right here, not as much high volume as you would expect, like a little bit higher. But this one wasn't necessarily as much, but you can see the volume did go up a little bit relative to the average traded volume at that moment was like 80 contracts, not a lot. And the overnight, it did kind of double, like, what is that, 200. So slight amounts as you push through it. But again, the overnight's just noise anyways. You're not always going to see a huge volume spike in the overnight, but you'll see like relative to itself, it does definitely pick up a little bit of steam as it breaks through, and that's it. But one of the things you would do is that when it breaks through, you're buying the dip off of the band to go higher. And that's basically how you trade it. And then you trade it to whatever pivot you have. Normally, DD bands or a lot of people force like a 2-to-1 trade. If they're going to take a 10-point stop, they let themselves get 20 points run. If they're going to take a 40-point stop, they'll let themselves get an 80-point run, things like that. Now, again, the neat thing I was here to show you is that these calculations from 445 the night before do produce high volume pivots. It's incredible how in the daytime session, it does produce those volume pivots. Right? Actually, right here. How'd you fall into it? So keep in mind that this is still in its infancy with Rocket Scooter as to how to fully incorporate these into the day-to-day trading. I just use them as an extra, okay, there's an exit target in the way because there's another pivot there. But as we find out that they do repeatably show high volume in the daytime session, you can't overlook it. But again, they probably line up with some symmetry of some other pivot that you might have in your day-to-day. So just keep in mind that they're also good acting pivots in futures, even without liquidity maps. And again, as beautiful as that is, they're calculated the night before the futures market even opens. And they're as good as they are all day. We post these in a channel called Futures Dynamic Hedge Pressure and the Bots and Tools. And every day I do this bot. So let's do one more just for fun. Let's go back to previous day. 6080 and 6075 was here. Was here. And then the orange was 6075, which was also there. Now remember, I created this as a way just to hedge your end of the day trade with what's the morning possibly going to look like. And it just so happens that we've stumbled onto something that we're still figuring out how we're going to use it. So just remember, in the overnight session, everybody, one final practice piece. The market opens here. Guess 2 of the 3 letters. With what you know so far, last practice one, and we're done. Are we above or below blue? Everyone quick. Above blue, we're long. Are the blues above the orange? Yes, it's another long up. Your long up rating, as you have these memorized, automatically says longing on the hedge pressures, right? We had like an 80% DD and closed in a bull zone the previous day. So I'm going to estimate that we're probably going to be a BLU as well the next day, right? So again, it's another way just to use this to try to get slight edge in the overnight. So we call these the overnight dynamics because they're useful overnight. Overnight, I don't say, aha, we're going to crash overnight. My brain says, aha, let me put an alarm on my phone right here and right here, just in case we fall to there. That way I'll grab the long. Sometimes I miss out on the overnight trade. That's totally cool. But every single night, I've always set alarms just in case it falls because they're very solid pivots overnight. And I can grab the trade. Now, again, just to review, it drifted away from them and didn't interact with them, so we didn't get the trade. But as you see, just like always, the market pivots off of them very readily Look how much we zigzag between. Well, this is the yellow line as well. But here and here, let me look at this. The market tend to have a lot of bouncing around inside of these pivots. Pivot here, bounce off of there, bounce off of there, right? So just to show you in the daytime, they have that activity. Let's do one more. We'll just do one more. 60.26 was here on the orange. 60.36 for the blue when they were both at the same place. So sometimes the high and low estimate ultimately ends up being the same. So you had a 60.36 low and a 60.36 high. That's okay when they're the same. They're exactly the same. All right, guys. Not that it's a parrot repeating themselves. Guess the two letters now. On this example, I set an alarm in Thinkorswim on the phone app. So if your trading platform has alarms and alerts, you can set your alert. I put it 5 points within hedge pressure. Okay. So guess the letters. Price opens here. Everyone guess. Quick, quick, quick. Above or below the blue? You're getting good at this. L for being above hedge pressure. The blue's above the orange. U for you. Another LU. Your brain says, aha, trade off the blue, trade off the orange. Perfect. And in the overnight, as you see, there's actual high volume in the Japanese session. Sometimes you'll get action, sometimes you won't. But what I do is you just sit here and wait, set your alert, and then let the market, oh, I'm at dinner. Oh, crap. Let me go check my trading platform. Oh, cool. Let me long to retrace it back up, or long to some target, or set a 10-point stop and try to get a 20-point run, or 10 to 5 or 20 to 10 or whatever. Arbitrarily set a 2-to-1 trade, because you're not going to usually bet that you're going to go to the DD band overnight. So you try to get at least more than 1-to-1 on your scalps. And again, in the overnight, it was a beautiful pivot, right? And just to show you, as all the examples to now the same thing, at 8 o'clock, when I don't know what exactly happened here, but some event dropped us to hedge pressure. And again, it pivoted there. And then throughout the night, it just has high volume pivots at that level. It's just interesting what we stumbled upon. And of course, just to show you again, in the daytime session, for whatever it's worth, as we've discovered, these two guys also create pivots. Pivot here, fall to there, trade to there, confirm there, breakout. So even in the daytime session, your dynamic pivots that you get that will eventually be automated on your futures chart will just give you another layer of information of pivots. You're going to treat them the same way, just like you would your liquidity map trade plan. Your brain will say, you know what, I got a pressure there and a pressure there. So you're just watching both of them. And you're going to say, aha, I have a trade there and a trade there. It's kind of both got upward pressures. The dynamics from the previous night and the liquidity map from today both kind of line up. So it's just another layer on your strength. So for you, you can use it as extra confluence to make your position slightly bigger. Or if the monthly hedge pressure dynamic is broken, maybe you'll use it as extra confluence to make your other position smaller. So remember, when you're trading, you want as many different angles as you can to give you clues. But it's all the same thing. Your clues really only do one thing: adjust the size of your position. And that's what all of the themes are here. Your longs and shorts are liquidity map, hands down. But we've so far used resilience as an indicator to kind of walk us down to a smaller position. DD as an indicator walks down to a smaller position. Or if you have a scare like dynamic monthly hedge pressure is broken, walk down in a smaller position or choose to sit out. Use this as an extra layer of clues just to decide how big you're going to trade. You guys got it? And I promise we're going to be looking into this and trying to have a bigger understanding as to how we wrap both of these up into a super strategy. Realizing this last year that the dynamics pivot as well as they do in the daytime was a shock to us. It was a member that told me that said, you know, I've been trading those pivots in the daytime. They work very well. And I go, huh, you know, that's an estimate model. It's a range. Yeah, but you bounce between those blue lines over and over and over again. And I go, well, huh, I didn't expect that. But it must mean that there's other people that are hedging at the min and hedging at the max because that's all you can guess. And it turns out that that's probably what's happening.